Welcome back, and our business editor Owen Fairclough is with me. Hello, Owen. Also joining me is European finance specialist Graham Bishop. Hello, thanks for coming in. You're here to talk to us about the latest developments in the Eurozone. We'll be going to that a little bit later on. First, though, Owen, the dramatic twist in that rate rigging scandal in the UK.
Claire, just when you thought it couldn't get any more dramatic, with Barclays virtually leaderless now, just hours after Chief Executive Bob Diamond quit over a rate rigging scandal that's already cost the bank some £300 million. He's now dragged England's central bank into the mire with new revelations from Barclays posted on its website, suggesting that the Bank of England all but endorsed one of the biggest scandals at the heart of British banking. William Hildebrand has the story for us.
Losing its chairman, while both its chief executive and chief operating officer have quit over one of the biggest scandals to engulf British banking. Barclays rigged the official interbank lending rate known as LIBOR that sets the price for a vast range of mortgages and other credit derivatives. And now Barclays has dragged the Bank of England into the mire. It's published a memo from ex-Barclays CEO Bob Diamond that suggests that BOE's deputy governor were lowering the LIBOR rate at the height of the 2008 financial crisis to suggest their creditworthiness was healthier than it was. In fact, banks like Barclays were loaded with toxic subprime mortgages that presented a significant credit risk. Analysts say it's an explosive revelation.
It's an absolutely staggering memo, isn't it? I mean, here you have the head of a large bank saying that the Bank of England, I'm not quite saying, but certainly dropping a very strong hint that the bank ought to be fiddling its numbers.
The Bank of England denies any wrongdoing. Barclays has paid $300 million in fines, though the latest revelations suggest other banks were rigging LIBOR before it joined in. But the fallout has been hugely damaging.
It's a reputational thing. If we go back 4 years ago to the subprime crisis, that did much more financial damage than this LIBOR scandal has done. But the LIBOR scandal just looks like out-and-out fraud. So I think it's the reputational risk to all of these banks.
With the bank almost leaderless, former chairman Marcus Agius will stay on as acting CEO. Diamond will testify before the British Parliament today in a scandal that's left the walls of Barclays and is threatening to reach Whitehall itself.
Now, Owen, from a consumer point of view, people will want to know if they've lost any money over this.
Yeah, and it's an important question that's perhaps been lost a little bit with all this talk about LIBOR, these CEOs who seem to be walking out of this bank on a daily basis. The problem with calculating it's difficult to calculate exactly how much people might have lost from this whole scandal. Now, just to put it in context, the LIBOR influences around $350 trillion worth of financial products across the world. So huge impact on financial services and financial products. Just some numbers for you. In the UK alone, it's estimated that maybe up to 300,000 mortgages in the UK were affected by this manipulation of the LIBOR rate. There's a company in the United States, Charles Schwab Corporation, that's now suing companies like Barclays and a number of other companies for losses over around $600 billion of investments. It hasn't put an exact figure on what it lost, but it thinks that manipulating the LIBOR rate meant that pension funds and clients of this company will have lost out fairly heavily.
And what is certain is that Barclays has already lost significantly. Yeah,
already paying out fines of £300 million. Remember, there are around 20 banks worldwide that are under investigation with separate inquiries into this in the United States, places like Japan and so on. And Barclays, as you say, has really suffered. Its share price has been down nearly 14% since the scandal, or since Barclays settled that case last week. And it's lost a third of its market value, as you can see there, over the past 12 months or so. Graham, I know this isn't really your field, it's not really the sort of macroeconomic stuff that you'd get into, but what's your take on this whole thing with Barclays? It's absolutely sensational that Barclays would publish on its website this correspondence between Bob Diamond and the Bank of England.
Yes, it doesn't stop there. Don't forget what it says is that the Paul Tucker, Deputy Governor, was reflecting concerns from higher up in Whitehall, and that at that stage would be Gordon Brown perhaps, or Ed Balls, the current shadow Chancellor of the Exchequer. So if this were to spread to back into the Labour government, it could be quite difficult for Ed Balls to stay clean hands.
He's the UK's shadow finance minister, and of course all of that's going to get an airing later this Wednesday.
Certainly will.
All right, I mean, let's take a look at the latest market numbers.
Yeah, the Asian market's having a good week so far, Claire. The Nikkei is up around 3% over the past 5 days or so, and extending those gains. You can see that just the Shanghai Composite letting the side down a little bit, but the Nikkei trading around about 0.5% up.
Okay, turning to the euro crisis now. German Chancellor Angela Merkel is in Rome this Wednesday for talks with her Italian counterpart Mario Monti. They represent two opposing sides of this debt crisis that are struggling to bridge their differences. Now, Graham, just going to bring you in at this point. Now, essentially, we have a German-led Northern Europe group that's very unhappy about helping countries like Italy without some type of guarantee or maybe even laying down collateral for help.
Well, the conditionality which they're after is already there in many ways. If you read, and these deeply obscure papers from the European Commission, they're on their website, of course, but the country-specific recommendations which have come out of this process for the past 2 months of looking at all the European economies together, 1,500 pages of very detailed recommendations. Read the stuff for Spain, and this is extremely powerful stuff. The labour market, pensions, etc., education. And when you look at what the finance minister said when they agreed to lend money to Spain, they took careful note of Spain's acceptance of those. So there isn't quite a public conditionality, but in practice it's there. These are detailed conditions.
And yet Mario Monti, I think in the past 24 hours or so, the Italian Prime Minister is basically saying, well, look, we're putting these reforms into place. You have to give us time. These things can't be done overnight, or maybe not even in a matter of months. These things take years. He really is saying you need to give us a little bit of breathing space.
Oh, and that's absolutely right. I reflect back 30 years to Mrs. Thatcher, and that took a couple of years, at least, before the reforms made to labour market practices, huge, very disruptive, strikes, etc., the lights went out and these sort of things. But it did work, and we then had 4% productivity growth each year for several years, turned the UK economy around dramatically. It takes time. And that's the point, that we have to have a structure which gives that time, and something which I've suggested, amongst others, is a treasury bill fund, because that would put cheap money directly to the governments, not into the hands of bond market people who want to sell bonds, but lend the money directly to governments at an interest rate which feeds straight into their budget deficit, i.e. lowers it.
And yet the logic seems to be going the other way now, insofar as we're talking about trying to directly finance banks, keep this money off the government books, if you like. He's saying that we shouldn't be going that way.
Well, the money to Spain, in the end, is on the Spanish government's books. There may be through a fund called the FROB, but that is wholly owned by the Spanish government. In the end, that's an obligation of Spain, no question about it.
And the markets realise this, the markets know this, and won't be fooled perhaps by what they see as maybe an accounting trick, really.
There are lots of accounting tricks in public finance which would not be acceptable in the private sector, but the markets realise that fully. The key element was the removal of the request that this loan to Spain be given seniority, because these are big numbers, and you suddenly find that if you're a private sector bondholder, you've slipped down the list of the priorities a long way, you're much more exposed, and if it goes wrong, you then get PSI, as they politely call it, default in normal terms, and that can be 75%, you've learnt in Greece.
The sort of thing we've seen in Greece.
So it's a real problem for the private sector.
What do you make of the Eurobonds idea, another way of mutualising debt? Do you think that'll ever take off?
Well, I used to think mutualisation was a good idea until I looked at the numbers. And the simple fact is that Germany is too small as a proportion of Europe to guarantee the rest of Europe. I mean, it's just basic arithmetic. So mutualising bonds is not the way to go. It's pro rata, and that's the ECB's balance sheet, it's the ESM, etc. All these new funds are all pro rata guaranteed. And Germany has accepted that before, so they should be able to accept it here. But the key element is, if you go for long-term bonds guaranteed, then you've lost leverage. Whereas if you do the treasury bills I was just talking about for 2 years or a little longer, then at each time they come up for renewal, you can ask the country, are you delivering on your commitments? If not, no more bills. Gives you leverage.
Okay, Graham. Graham Bishop, thank you very much for coming in. Thank you, Owen. That's it for business in this half hour of Live from Paris. Stay tuned. Stuart Norval will have all the headlines in just a few minutes' time.